It's time now for your bond update, and even though it's been a good year for most risk assets, the safer ones have done even better in the bond market. Just look at Germany. For more, let's bring in Lisa Abramowicz.
Yes, Carla, I find this fascinating. You're certainly seeing it in pockets in equity markets, but certainly in bond markets. Investors have been gravitating toward risk, but even more so toward those safest bonds. We're talking treasury yields coming down. It's what you were talking about with German bond yields. Take a look at the total return of investment-grade bonds versus high-yield bonds year to date. Investment-grade bonds, which are more closely linked to treasuries, have returned more than high yields, 11.3% year-to-date gains on the high-grade index versus 10.5% gains on the high-yield index. If you flip up the boards, another way to look at this is that what you're getting is investors demanding still a significant premium to own high-yield bonds over investment-grade bonds, even as yields more broadly go down. So this gap, while it has narrowed from the highs, it still is historically high post-crisis, which I find really interesting. In other words, even though investors are being pushed into riskier debt, they are offering up some discretion, saying we want to be more sensitive to companies that can withstand a downturn, even as the music is still playing.